Hello and welcome. This is Reema Tendulkar live from the TCS headquarters at Fort in Mumbai. We're awaiting the TCS Q3 numbers. Right now we have the bottom line with us. The profit is coming at 10,846 crore. That's a growth of 4% on a quarter-on-quarter basis, slightly lower than the 6.5–7% that the street was anticipating. On the top line, it appears to be a revenue growth of close to about 5.3% seen on a sequential basis. But the key numbers that we are awaiting are the dollar revenue numbers as well as the margin performance and an indication of what the future demand is going to be. So commentary around deal wins, hiring, that's going to be very crucial. Still short of details right now. Some statements coming in from the management. N.G. Subramaniam, the Chief Operating Officer and Executive Director of TCS, says, as I look back at 2022, it's gratifying to see the privileged partnership that we continue to enjoy with our clients globally. In a hybrid working model, we've delivered many complex transformation projects tailored to the specific requirements of our clients' ecosystem with speed and agility. It's also refreshing to see our delivery centers and Paysport labs busy with consultants and client executives jointly reimagining solutions to deliver the future. The year also saw us embracing data, AI, ML holistically to disrupt ourselves and drive competitive advantage. All this augurs well as we step into 2023. Samir Siksaria, the CFO, says improved productivity, currency support and abating supply-side challenges helped expand our operating margins in Q3. This gives us greater confidence in our ability to steer our profitability towards our preferred range while continuing to invest in building newer capabilities to support our growth and market share gains. Those are some statements that we are getting. Milind Lakkar, who is the Chief HR Officer, CHRO, says our focus over the last few quarters is about bringing in fresh talent at scale, training them on new technologies and making them productive is paying off. We're particularly proud of having 125,000 TCSers at middle and senior levels who've been with the company for more than 10 years on an average. Just trying to get some numbers in. Operating margins for the company have come in at 24.5%. This is slightly less than what the street was anticipating. It's still an expansion seen on a quarter-on-quarter basis. The quarter-on-quarter expansion in margins is 50 basis points, but the street was anticipating a margin improvement of 70 to 80 basis points. So on the top line, there has been a bit of a slip. Order book for the company has come in at $7.8 billion, which is within the company's guided band of $7 to $9 billion, but it's lower than the $8.1 billion that the company had clocked in the prior quarter. Attrition has come in at 21.3%. Now, this is slightly less than what the company had seen in the prior quarter, which was 21.5%. Awaiting the top line number, the rupee revenue growth or the dollar revenue growth is about 13.5% seen on a year-on-year basis, but we still don't have the number on a quarter-on-quarter basis. So 13.5% is the company's revenue seen on a quarter-on-quarter basis. So those are the numbers that we have. The top line growth has crossed $7 billion is what the company has indicated. Just to summarize the numbers that we have right now, it's a constant currency revenue growth of 13.5% on a year-on-year basis. Margins have expanded by 50 basis points, but slightly lower than what the street was anticipating, a margin expansion of 70 to 80 basis points. The order book or the order wins at $7.8 billion is within the company's guided band of $7 to $9 billion, but it's less than the $8.1 billion that the company had seen in the prior quarter. The headcount addition has come down. The net headcount addition has declined by 2,197. Remember, since COVID, the company has always seen its headcount addition go up, but this is the first time we've seen the headcount addition come down. Attrition has fallen after 6 consecutive quarters of an increase. Attrition is now at 21.3%, which compares with 21.5% in the prior quarter. BFSI has seen a growth of 11.1%. So that's slightly slower than the growth that we'd seen in the prior quarter, which was about 13%. So there is some slowdown seen in the year-on-year rates for BFSI. Retail has been strong for the company at 18.7%. This compares with about 23% growth that they had in the prior quarter. Manufacturing is up 12.5%. In the major markets, North America and UK is up 15.5%. Continental Europe too has slowed down a bit at 9.7%. We've got Prakash Diwan with us. Prakash, thoughts on the numbers?
So, I think Nima, the first cut there's nothing very spectacularly or remarkably great about the numbers, but it's kind of within the expectation band. Particularly, I think the revenue beat is commendable because there was expectation that there could be some stress given the cat amongst the pigeons that HCL Tech had released with the furlough data. So I think that hasn't really impacted TCS as much, is very clearly evident. But my sense is that the street might not be very excited, going ahead with this kind of a slip in the profit margins. I mean, the margins are good, but they're not as anticipated. So there could be a little bit of a nitpicking there. But I think what these numbers tell you is that things weren't as bad for the quarter. And more importantly, if the commentary for the quarter ahead or the year ahead as a whole is good, you probably have a very good second half calendar 23 is my guess. But these numbers tell you that it's humming, or it's not something very very different than what we had in the previous quarter to go with. Yeah.
Okay, we don't have the dollar revenue numbers, but a 13.5% constant currency revenue growth is largely in line with what the street was anticipating. For instance, Ambit was expecting about a 12.8% constant currency revenue growth. So TCS has largely delivered in Q3, but you would say there is no positive surprise that's come through. Prakash, the big question is really on the valuations right now. So TCS is trading at about 25.5 times forward multiple. It's off from its peak levels of 31, 32 times, but it's higher than the pre-COVID average multiples of 20, 21, going up to 22 times. So while Q3 has delivered this time, the fear is what the next few quarters hold, given the macro uncertainty. And there is a risk that revenue estimates will scale down. The deal wins that the company is reporting right now are the deals which have been in the making for the last few quarters. Perhaps it's only in Q4 of FY23, Q1 FY24 will we start seeing the deal wins slow down if indeed the tech budgets are tightened and are flat. So your thoughts on valuations, and if there is no positive surprise in the numbers, how do you think the stock will react? What's the positioning like?
So, I'll take the latter part of your question first, Rima, because on Monday during the trading session, I think the market built up the expectations given that there was nothing much that could go wrong in Q3 for some of these larger numbers. And then especially, TCS was playing more of catch up with Infosys in terms of crossing that revenue mark. It's something where, they did sound positive in the last commentary itself, and Q3 is more of a continuation of execution of the same contracts that you have for calendar 22. So there's really not much to upset it, except for if the furloughs were to hit them, as I said, which doesn't seem to be the case. Going forward, if you look at the 29, 30 times bands that we've seen on the higher side at times, even currently the valuation is not something which is very attractive. So from a risk reward perspective, the risk is more on the downside than the upside. Even if they deliver, or there is an improvement in margins, or there is a continuation of order wins that is impressive, which is seeming to be more like if everything goes off well in the US, they'll probably do as well as they did in 22, but not maybe better. So that's what you're penciling in, that even a status quo of sorts on the book, on the win book, it's good enough for these valuations. But anything less than that, and the valuations could hurt. So that's my guess. You'll have to give it this first 2 quarters without really getting exuberant about anything, unless, as I said, the commentary comes up with something which we don't know of, or which the management is visualizing in terms of envisioning much more strongly going ahead. But I think the valuations are fairly, the stock is fairly valued. So from a positioning perspective, you really don't have to add anything to the portfolio at this juncture. It's not in that attractive zone. You'd probably have, as I keep on saying, more of the likes of Tech Mahindra and all, which probably have an optionality or an upside attached, which you would look at, but not TCS for sure.
Okay, now we have clarity on what the company's revenue numbers look like, and there is a beat on the top line. Dollar revenue growth has come in higher by 2.9% on a quarter-on-quarter basis. This compares with the CNBC TV18 poll of 1.6, 1.7%. Even in constant, even in constant currency terms, it's a growth of 2.2%, again higher than the 1.5% that the street was anticipating. So to summarize the Q3 numbers, revenue beat, margins miss, deal wins have slowed down on a quarter-on-quarter basis, but within the company's guided band. The only negative in the number, perhaps, is the fact that the hiring for the company or the net employee headcount has declined by nearly 2,200. One of the reasons could be the fact that the attrition is also coming down. Attrition for the company is lower after 6 consecutive quarters of increase. So now that you have fewer numbers leaving the employee, the TCS, fewer numbers leaving the TCS workforce, therefore there are fewer people that you need to hire to replace them. The backfill attrition. So that's one of the reasons. But very often, the street also sees the hiring numbers as a proxy for future demand. Moshe Khatri is with us. Moshe, revenue performance is very strong for the companies, 2.2% on a constant currency basis. Considering that this is a seasonally weak quarter, HCL Tech had already flagged off higher furloughs in many verticals, and the street was worried about longer decision-making cycles, a cutback on discretionary spend. How would you read the top line? And would you look past it, saying that the next few quarters could still be muted given the macro uncertainty? Or would you read this as the trend on what we should expect?
This was never about the quarter itself, as you know. I think the numbers were expected to be pretty strong just because the budget's already set. HCL Tech is probably more company specific, given the fact that the company does have a lot of exposure to the high-tech industry. That's number one, where that's where we're seeing some weakness, obviously, given some of the furloughs, and obviously because of their IBM because of their IBM assets that they've acquired a couple of years ago. But in general, I think it's going to be more about what happens beyond the December quarter. We continue to see, I would say, a very fluid situation in terms of spending decisions. The budget cycle, that's probably going to be set a bit later than usual. So you're probably going to have a slower than usual March quarter. And after that, you may see, an improvement from there sequentially. But the quarter, in my view, is pretty much in line with what we thought it's going to be. And it's more about what happens beyond the December quarter at this point.
So you're expecting a weak March quarter. What about a June
we're
quarter?
expecting
How long do you think this weakness could last?
So I think we're going to see what we've seen during the prior down cycles, where budget decisions probably going to see a slippage, maybe by about a month or two, because of the macro. You're definitely going to see a moderation in budgets. The good news is that the street is already factoring that in expectation. So Street's expectations for fiscal 24 are roughly 10-11% growth for the sector. That's easily 50% moderation. And obviously, this factors what we call a soft landing scenario.
I was just looking, Moshe, at the Nomura estimates, and they said revenue growth for TCS was 15.9% in FY22. This is likely to come down to 7.5% in FY23 and further moderate to 5.3% in FY24 before improving in FY25. So street expectations have materially, come down in the last 6 months. So the first leg of the decline that we saw in the IT names was on the back of margin misses. Then it was on the back of a PED rating that we saw due to higher interest rates. And in the last 3 months, the EPS cuts we've seen some EPS cuts, which have also resulted in some down cycle. What would be the read-through for the rest of the sector, Moshe?
I think that, again, you have to make certain assumptions about where this macro is going to lead us to. I don't have a crystal ball, but there are some interesting scenarios here, right? So first of all, the financial services sector, which has been very, very weak during the last downturn, I'm talking about 2008, seems to be in a better position now. So that's a good thing. this is really a macro that's driven by Fed decisions more than anything else. And that's why I call this a very fluid situation. And that's why it's really difficult to play the 2008 market crash kind of playbook. And so you have to make certain assumptions about how severe the downturn is going to be. Is it going to be a soft landing? Is it going to be a hard landing? Going from mid-teens growth to 5% growth year over year, that sounds to me like a very severe kind of downturn. And I don't know if you're here yet. So that's why, the way I see it, that 10% growth that the street is looking for, at least based on what I see it here out of the US, seems to be a bit more realistic. But again, we're going to have to wait and see how the budget cycle is going to look like, how the macro is going to look like. The numbers out of the US last week, especially the employment numbers, continue to look fairly okay. So, that's why I think it's really difficult to come out and make that call about where the global economy is going to be. And obviously, this will impact spending. It is a fluid situation, and the December quarter, is not really what it's about. It's more about what happens during the next few months about the budgets.
But the lead indicators have been a bit soft, right? Headcount addition is negative this time for TCS, and even the order book has declined on a quarter-on-quarter basis. Moshe, would you say that this time the downturn that we are likely to see in ITs? Okay, we'll have to leave you at that. Moshe, thank you very much for joining in. We'll also thank Prakash Diwan on that note. The press conference of TCS is about to begin. We've got the top management speaking, so let's cut across.
Reported revenue terms crossing 58,000 crores in rupee terms, and importantly, a big milestone for us, crossing $7 billion in quarterly revenue in Q3. Importantly, this strong growth has come with increasing profitability. We have registered 24.5% profitability for Q3, and that translates to 14,284 crores in terms of operating profit. Net profit has also grown sequentially by more than 400 crores, getting to 10,846 crores, and at an EPS of 29.64. Our profit conversion or cash conversion of net profit continues to be very strong. We have converted at more than 104%, with cash from operations of 11,154 crores. The board has declared interim dividend of 8 rupees and a special dividend of 67 rupees, bringing the total dividend declared in Q3 to 75 rupees. With that, our total payout to shareholders by today will be about 33,000 crores, of which about 28,000 crores will be from what is going to be paid in this quarter. Our performance on both on the revenue side as well as on the profitability side is also reflected in our strong customer portfolio. Our number of customers from whom we make more than 100 million rose by 1 to 59 customers on a year-on-year basis. The growth has been led by our significant investment in talent development through the year. As you know, we had hired significantly in the last year, and that has been the basis of our growth. We've been able to leverage that investment, and our net headcount addition this quarter now is at about 57,000 on a year-on-year basis, bringing our total associate count to slightly under 614,000 people. Our attrition, as we had called out earlier, has peaked, and I'm happy to report that on an LTM basis, now we have started ticking down, coming down slightly lower than last quarter at 21.3, and we're quite confident of this trend continuing and more significant reductions in the quarter ahead. Our focus on innovation continues to be very strong. We have been reporting to you the number of patents applied. Now today we have 7,134 patents applied, which is an increase of 738 on a year-on-year basis. Even more importantly, our total patents granted has now grown to 2,694 patents, which is up at 493 patents on a year-on-year basis. I've said this before, but it's very important that our patents granted now is running ahead of 1 patent a day on a calendar day basis even. We are very proud of the tremendous impact that our R&D team is having, both in terms of the dedicated pool of about 7,000 researchers that we have, and even more so in the widespread adoption of the research and innovation culture across the wider TCS population, and as supported by our ongoing investments, not just in R&D, but also in creating the right enabling infrastructure, least of it not being the pace ports that we are continuing to open across the world. Coming to segmental performance, revenue growth once again has been led by strong growth in North America, growing at 15.4% on a year-on-year basis and getting to $3.8 billion in reported revenue. UK is a market where we continue to enjoy strong growth in a very challenging environment, and UK also has grown 15.4% on a year-on-year basis in constant currency terms. Europe, despite challenges, we have been able to maintain a good growth rate with a year-on-year growth of 9.7% in an extremely constrained environment. The segmental performance from a vertical industry perspective has been led by verticals like life sciences and healthcare, which have grown at 14.5% on a year-on-year basis, retail at 18.7%. Manufacturing has also had a good quarter, and BFSI has come in at 11.1%, getting close to 2.25 billion in overall revenue terms. So that's the wrap on the numbers for the quarter. In terms of overall demand trends, I think the quarter has been and continues to be about different markets behaving differently. North America continues to remain quite vibrant, and overall the economic stance and customer perspective there continues to be quite supportive, if cautionary. UK is, as I said, a challenging operating environment, but our solutions are finding a lot of resonance with customers, and we are significantly gaining market share in that market and continuing to do very well. Europe is the market where client decision making is getting impacted by the ongoing geopolitical challenges there, and requires close watching in terms of how it progresses through the quarter. Otherwise, we are quite happy with the performance, and thank you all for listening in, and we'll open it up for questions from here. Thanks, Kritika.
Thank you, Rajesh. So we start the questions from the journalists present with us, and then we'll get a couple of questions from the journalists that are joining in online. So we start with Sajid Mangat, BQ Prime. Sajid, 2 questions, please.
Yeah, I'll start with 2 questions. Happy New Year, Rajesh. Can you take us through the demand environment? You spoke briefly about it, but in your commentary, you mentioned about short-term uncertainties. When you look at it from an October point of view and now in January, how have you seen that moving from uncertainty point of view? Is it now you think that it's coming to an end and you have much better visibility on that? Secondly, growth rate. Bill to book, I think you have 1.1. I think last quarter you mentioned 1.2, if I'm not wrong. Is orders coming in a little slow? Coming in, you got $7.8 billion, but is there a slowdown which is happening in closing the deals which is there? For Samir, on the margins front, 24.5%. Do you see much headroom as you go into that? The pressure of wages and talent, has it come down significantly for you and for NG? Can you give a bit more on the BFSI space, how it's looking in the US especially? And HR account, negative 2,000 net account. So what went into that?
All right, Sajid. I think the demand and the pipeline is so overall demand scenario has not changed significantly. But to be fair, it would take at least a couple of months more for us to actually know what the decision making is. We have gone into December with everybody being cautious. But our view is that this caution has different color across markets. So if you look at Europe, there is obviously a real big issue out there. And it would take some time for this caution to dissipate. And we need to be cognizant about that, and we'll see where it goes. But if you look at North America and UK, which together constitute about 2/3 of our revenue and probably 3/4 of our profit, the environment there is very different, very supportive. North America, while this quarter and probably maybe the start of the year might be a bit cautious, but our own view is that into the year, we should see a fairly positive one because there is no structural challenge there. Of course, this is subject to how the whole inflation scenario plays out. But on our one-on-one conversation with clients, we think that this is a caution that is more in terms of being wary and taking a decision slightly delayed rather than anything comparable to Europe. UK, the environment is challenging, but given the fact that there is no immediate flip there that is expected, customers and industries have moved forward in terms of the decision making and are committing to large scale, sometimes cost transformation, sometimes more structural transformations along the lines of what, for example, the deal that we have announced with the leading telecom provider there. So UK, though the economic environment is bad, the decision making is much more decisive and much progressing well. So we are participating in that. So that's the spectrum of demand that you see. And the pipeline also kind of reflects that. 7.8 billion is right in the middle of our target range of about 7 to 9 billion. So it's not bad in itself. Sequentially, it is down a bit. On a year-on-year basis, it is growing. But if you compare it against our dollar growth rate on a year-on-year basis, it's a tad lower than that. I think that's a good reflection of where the scenario is, that in terms of the overall demand.
On the margins, we started this year at 23.4% after giving a full cycle of increments. And then we have made good incremental progress so that during the last 2 quarters. We are ending Q3 at 24.5, and we are very focused on exiting this year at the same margin which we exited last year at 25%. On the wage front, the supply side challenges abating is definitely helping out, because more so on the elevated expectations of salaries and the backfilling retention expenses, that having come down is definitely helping on the margin side.
Yeah, BFSI has grown well. It's about 11% year on year in this particular quarter. Even by the deal momentum, $2.5 billion of deals is coming from BFSI. Overall, there's nothing to specifically call out, especially, more than what Rajesh had pointed out. The decision making in sometimes, is getting slightly, delayed, but then there is nothing to call out as a worry at this point in time. And going by the interactions that we have with our customers, they're all engaged with us in doing multitude of projects. Some are technology transformation, some are related to regulations like data localization, large-scale payment restructuring, payment re-engineering, those kind of aspects. So, I think there is nothing to call out, whether it is in the North America or UK or Europe. Seasonally speaking, this quarter we had certain furlough impact, more in Asia Pacific than in other parts of the world, but nothing special to call out. It's more or less the same that we typically face in this particular quarter, right?
Was the furloughs higher than a normalized level every year?
No, I think it's comparable.
Sajid, you are aware that we made a significant investment in hiring fresh talent last year, as well as the last 2 quarters of this year. and also significant investment in talent development of these people to make them productive now. And that investment is now paying off. Coupled with all the tightening which was talked about earlier by Samir, all of that together basically resulted in a negative headcount. But that does not indicate anything on the demand side. Demand is high. We're just operating it very efficiently right now.
On the absolute level, are you putting more people back on the operations because you had a good, on an absolute level, the bench was high for you?
Yeah. Bench was high for us, and then we were obviously getting also people in the last couple of quarters. So all of that together, we are putting more and more people, making more and more people productive and putting them on project work.
Reema Tendulkar, CNBC-TV18.
Good evening, gentlemen. Squeezing in a lot of questions here, so apologies in advance. Rajesh, first question is on client budgets. Are they closing on time? Is it increasing, decreasing, the reprioritization that we're seeing? Second, on sectors. Last time you had called out PNC, insurance, the discretionary spend in retail. Can you tell us any more sectors where you are seeing some headwinds or caution emerging? And just to take forward the statement that you made, looking ahead and beyond current uncertainties, our long-term growth outlook remains robust. How long do you think this current uncertainty, if we are in a demand down cycle, will it be compressed? How long do you expect that to last? Samir, do you maintain exit margin range of 25% for Q4 FY23 that you had guided earlier? And despite a very strong top-line growth, if you could tell us why was the margin expansion capped at 50 basis points this time? And your peak margins were 26.85% post-COVID. Do you have the visibility that you can get back to that? Because you are talking about steering your profitability towards your preferred range. NGS, is there a risk of deal wins going below your range of $7 to $9 billion? In the event of a macro uncertainty? And if you could talk about the deal cancellations, are they closing on time? And Milind, has the attrition has come down after 6 consecutive quarters of an increase, but not significantly. So has the easing of supply side been up to your expectations or a little slower? And if you could guide a little bit more on attrition. Thank you.
All right, I'll try to remember everything and answer it. In terms of vertical industries, I don't think there has been any major change in what we have said. So if you think about it, actually what we had said was that we expect this time that manufacturing will be where the impact will come. So far, manufacturing has held out. It has not been as impacted as we had originally thought, let's say 6 months back. So we need to wait and be cautious about it, but it's a good thing and we are participating well. So, so far manufacturing is holding out well. BFSI, as NGS said, is growing well. Within that, insurance is slightly weaker, but there's not much to call out on that. And I don't think there is any specific trends there. Retail, when we look into the market, especially if you look at North America, retail sales into the holiday season have been quite strong. Retail profitability has been impacted because of overall cost increases, and they're not been able to pass on all costs to the customers. So the retail industry will go through various transformation initiatives, I'm sure, and we should be able to participate well in that. But net, actually the holiday volumes, even adjusted for inflation, has come in higher than last year. So the industry is in good shape. We'll have to they have to work through the cost implications. So so that's why. So if you think about it from a structural perspective, with the focus on US as a more stable economy, we think that barring the current extreme focus on the economic environment, structurally most industries are in a good shape, and we are well positioned to participate irrespective of where the focus is, cost or on the growth side of it. UK I already answered when I spoke about Sajid, and Europe is very difficult to call. So as of now, we don't have visibility as to what the final decision on the budgets are. That visibility will emerge later in the next few months as actual project releases come. but what I just explained to you is based on client commentary going into the holidays. So the distribution that I told between. We'll get to know that as we, no, it is a normal cycle that we get to know of it only during the course of these 2 months, because as you see the project releases and what happens, so towards March, we'll be in a much better position to talk about where we see the pipeline. It's first week of Jan, there's not much of early indications, people are just about coming. So that's the spectrum of, you know. The current uncertainty, again, is market specific. The US should resolve itself very fast because you know, we should know quite soon which way it is heading. Europe, nobody knows. And the UK, there is no uncertainty. The medium-term environment is well understood. And companies are moving in that, based on that decisively. So different markets have different time frames.
Coming to margins, yes, we are absolutely focused on exiting Q4 at 25%, which is exiting the year at 25%. And there would be puts and takes in terms of how it plays out, how the quarter plays out. But as a management team, we are absolutely focused on that. Coming to Q3 margins, we had a 50 basis points improvement. And as I mentioned, we have been progressing steadily on our target range. In Q3, we had 70 basis points coming in positive from currency. And additionally, we had 30 basis points coming in from execution rigor, mainly on account of better utilization, realization, as well as reduction in fees to external consultants on a net basis. And this was offset by higher project-related third-party costs and increasing cost of return to normalcy. And I think last question was, when do I get back? So our first target, we'll take it a step at a time. We'll get to 25%, and then we'll try towards getting to our comfort band as soon as possible.
See, overall, the deal momentum, the deal pipeline looks really good. And our qualified pipeline has actually gone up, okay? Both in terms of medium to small deals as well as the large deal pipeline. So on that count, you know, I have no concerns, right? Where we are today with respect to the deal momentum. And at this time of the year, every year, where we are comparatively, we are feeling there's a feel-good factor about it. Nothing else to really call out, you know, pretty much. And then, you know, the tech spend per se seems to be intact from my perspective, because you have this, you know, cloud-related investments that everybody is doing, right? It's actually a race to the cloud, as somebody told me. In that context, that, you know, it's really, you know, people are looking at not stopping it, but then looking at cloud 2.0, and then see how we can progress with the Horizon 2, Horizon 3, specifically, you know, how we can employ machine learning, AI, etc. on the edge. So those kind of investments, I don't think that they're going to stop and start again. You know, that kind of a thing is not affordable. So from that perspective, I think, you know, the deal pipeline, the kind of thing that we are working on, gives us a feel-good factor.